Welcome to Market Outsiders, where business news meets real insight real fast. In just 15 minutes, the management consulted leadership team, Namaan and Jenny Rae, that's me, breaks down two major stories through a business lens, helping you spot what really matters underneath the headlines. We cover economic news, market news, and business stories that are incredibly interesting and updated daily. These are the things that drive markets, both from the inside and from the outside. You can catch Market Outsiders live every weekday at 9:15 a.m. Eastern on LinkedIn and YouTube, just before public markets open in the U.S. Stay tuned in right here to get every episode on Monday through Friday.
Welcome to today's edition of Market Outsiders. It is Monday, August 11th. It is a slow news day, not when it comes to the business world. My name's Namaan. I'm joined by my colleague and co-host, Jenny Rae. We're here today to break down one interesting, noteworthy, and relevant to you business news story for today. Before we get into that, Jenny Rae, how are you and how was your weekend?
Hi, Namaan. I'm great. Look, yesterday was surfing on the beach with a plane dragging a thing behind it, which my kids always point out what they're saying. But this one yesterday was notable because it said tariffs are taxes. And you don't often see that kind of on the beaches of Southern California, but there you were. So you could have been surfing and thinking about politics at the same time. What a day. How about
Not
you?
just politics, economic policy as well. That's a trifecta right there.
That's right, baby. That's right. How about you? How was your weekend?
It was good. I spent it knocking out a long to-do list of errands, which sounds like torture to some people, but is actually strangely relaxing. You know, a lot of our work is done either on planes, at airports, or like in front of a screen. So being able to do stuff not in any of those settings was strangely relaxing. So I'm ready to go for another great week ahead.
Was there caulking involved? That's all I need to know.
Yeah, no caulking this weekend, thank God. But I think there's more plumbing in my future. So I'm actually okay that it's not next weekend yet.
Honestly, I do have to say, just as a complete aside, we were in the mountains last weekend and there was a dripping faucet. And this is the mountains of North Carolina. This is like post-hurricane recovery. There's not a lot of just available labor to come and like help out with something. So we knew it was going to be a while. My 13-year-old replaced a faucet and fixed it, including going to get the right parts from Home Depot. And to say that I was impressed is a complete understatement. So if any of y'all need him, apparently he's getting a long list of inquiries already. I feel like the future of the trades in America is very bright. So my 13-year-old is in on it and he's already ready to go.
I love that. As a complete aside, I found AI to be an incredibly helpful, like, handyman mentor. It beats like the best YouTube video 10x. So
I don't know if this is true
between calling
or not,
your
but
13-year-old and referencing ChatGPT, I'm feeling pretty good about my own chances here.
That's right. Yeah. I would have said that would have been great. There is like zero, there's actually zero internet access in this particular part of the mountains. And so it kind of helped me recognize how relying on not having to YouTube something was going to be really valuable and important, because not being able to ask AI and not being able to ask YouTube what the key fix was for this faucet, like the kid just had to know how to do it. And he didn't know, he'd never been taught, but he did figure it out, which was kind of fun. So anyhow, I don't know how we're going to make the leap. That's right. I don't know how we're going to make the leap from that to what we're going to talk about today, but that was kind of a fun moment for me in the last few days.
Here's how I'm going to make the leap. So the topic we're talking about today is stock buybacks. Usually you have CFOs and boards of companies who make the decision on stock buybacks, and I can guarantee you they were not doing plumbing this past weekend. So, so that's the connection right there. There was a story this morning in the Wall Street Journal. It was on the front page. It caught my eye. I thought it was interesting, just around how this has been a record year for stock buybacks. And you often hear about stock buybacks in political terms and in a political context because you have some politicians who rail against them as evidence of corporate greed, right? And so I don't have a political take on this. I just thought today we could walk through what's a stock buyback, why would a company decide to do it, and then what are some insights that you can extract as either a business person or an investor to just give you a clue as to what's happening in the economy and what is perhaps about to happen in markets? So that's what we're going to talk about today. Jenny Rae, before we dive into today's news, would you just like to define for us what a stock buyback even is?
You bet. Namaan, can you just read the headline of the article? We're not going to show it yet, but can you just read the headline of the article so we have it for context? I'll talk about the question it would spark, and then I'm going to pull up this article to talk about some of the insights that we want you guys to have. Do you mind just reading that article headline?
So for those of you who want to look this up later, we'll put the link in the description, but it's a Wall Street Journal article. The title is "American Companies Are Buying Their Own Stocks at a Record Pace."
Love it. Okay, awesome. So when you hear that, right, there are, I think the first insight that you could have is American companies are buying their own stock at a record pace, right? It's just like exactly what it says. It's kind of at the headline. And you could walk around and you could have coffee with somebody and you could spout the fact and it would make you sound incrementally smarter than you were before you read it. So like reading a headline is worth it for that alone. But really the actual extraction of the learnings here come from understanding what it means. And so understanding what a buyback actually is, how they're mechanically triggered, and then also why somebody is doing a buyback is important for a single company. And then we have to make an extrapolation for the larger economy, for this moment that we're in, for what this actually means. And I think y'all have known, if you've followed us for any time, Namaan and I are traditionally pretty contrarian when it comes to what's being said in the markets, what's being said about a specific company. We often find that there are false extrapolations that people are making. And so really getting an understanding of the mechanics of this, I think, are super important. And so I'm just going to pull up and actually, while I'm doing this, I want to just like say a super quick aside. When I was looking for this article, today is the first day, whatever today is, like August 10th, 11th, was the first day that I've actually seen this on Google. It came up with an AI squeeze, which means that there were no listed articles with links on the AI response. And so I could have read you the AI version. I intentionally didn't do that because I think part of going beyond the headline is not reading a summary that could involve hallucinations or contradictions from different sources. And so even though I think it can be a helpful starting place, I went one step further, but I think that's pretty notable just to mark this day as a shift for when that happens. Certainly as a business that thinks about the way that people look for information, that's how they find us. That's notable and important, and you should pay attention to that. But we're not here to talk about Google and AI. We're here to talk about buybacks. So what is a buyback? Buybacks are as old as we've had share issuances. So buybacks, also known as share repurchases, and this is according to Investopedia, occur when a company purchases its own outstanding stock shares to reduce the number on the open market. And so first things first, what is this? Basically, at the whatever market price is at the time, the company executes a trade and it purchases the shares back and it reduces them, the number that are in total in circulation. The opposite of this, of course, is an IPO or a share issuance. Where you are increasing the number of public shares that are available on the market. And what it does, it's a strategic move that aims to enhance the value of remaining shares by decreasing the supply. So basically what it functionally does is it takes, if it's a dividend stock, for example, all of the dividends that the company is paying out are then, of course, paid out on a smaller number of shares, which increases the dividend payment. Any incremental trading value is less tied to company performance than something like dividends because they're market driven. But still, if there are fewer shares, it does usually have the intended effect, which is to increase the value of those shares. And go ahead, Namaan. I was going to say one more thing about it. But...
I was just going to say it puts upward pressure on the price of the stock, right? Whenever you limit supply, price is typically going to go up. I think what you also do, right, like you typically in a normal market environment, stock price is determined by earnings. And so when you have fewer outstanding shares, your earnings per share go up. And earnings per share is a key metric that the market uses to value a company and value a stock. So it's almost like a little bit of an artificial way to juice that number as well. It's just, hey, our earnings per share are higher because we have like the denominator is smaller. And so that's like a useful benefit of buying stock back for a company as well. The last thing that I'll just say, and I'm sorry to interrupt, I'll let you get back to your insights as well. The last thing I'll just say is it signals a position of strength, right? Because you have the liquidity to actually go and deploy capital to be able to buy your stock back. Like the reason you would issue shares is because you need liquidity. So if you're able to buy stock back, you're signaling to your investor base, you're signaling to the market, our cash position is strong, and we are deploying that capital to kind of raise the value of our stock for the existing shareholder base. And so like if you are not a dividend paying stock, this is one way that you can kind of nod to your shareholders and say, hey, look, we're looking out for you. We're going to buy our stock back. This is going to raise the value of the stock that you do own. And so lots of reasons why you would do this. And I think it's, a sign of just the strength of the American company's balance sheet, right? Corporate America's balance sheet, that like they are on track for a record year of stock buybacks, right? Like if they have the money to do this, all right, it's just a good sign, I think, for the health of at least corporate America, if not the overall economy.
Absolutely. And so when a lot of the factors that are often not factored into stock prices are your cash balance. How much cash do you have on hand is not usually one of the predicators of what your actual numbers are. In fact, sometimes companies like Berkshire Hathaway or Apple get dinged for having too much cash on hand because as a shareholder, you don't want them to hold the cash. You want them to do something with it.
Deploy it.
So going back to some of the options for what you can do with cash, one of the options is, of course, to buy back shares here. What are the alternatives? Well, you could acquire other companies. Usually this is saying that you believe that the investment in your core business is more valuable than incremental investments purchasing other businesses. So that's one thing that you could do with it. You could also invest in business operations. If you're a manufacturing business, you could open a plant with this money and you could accelerate the opening of those plants. So you're taking some of those kind of operational decisions potentially off the table with a share buyback, which also represents a sign of health. You're saying that I think that we can get to where we need to go and further by repurchasing shares instead of, going forward. I just want to highlight one key point of interest that really got, I think, flung into the news during COVID is that prior to the COVID years, the 4 major U.S. airlines all had major share buyback programs, and they got dinged for it politically and in the markets big time during COVID because it restricted their ability to have cash on hand to handle the COVID period. Now, COVID was the equivalent of a 10,000-year flood, right? It was a very unusual confluence of events. So I don't necessarily fault any of the leadership, but you also do take off the table business durability, right? You take off the table risk hedging, and you're basically saying that we believe that we've factored in a significant amount of risk already, and we don't need to continue to risk hedge. And so that's another piece of the bullishness of the economy. The last thing that I just wanted to highlight here, Namaan, which was kind of like a little asterisk, but we've talked about this in a couple of other episodes, is that when you reduce the supply of the available shares, and especially if you consolidate the shares that remain with friendlies who are on your board, who have positions that are pleased with your current management, you prevent hostile takeovers because the amount of available shares that somebody could accumulate to acquire a position on a board or to build enough of a position to develop a hostile takeover is not a part of the equation anymore. So we talked about the undervaluing, the strategy, but I did want to also add that in. Overall, it's a flex. It's a flex in the market. To do a share buyback is a flex to say we are great at our current business operations. We do not need this excess cash. We have enough other excess cash to do the other things that we want to do. And we therefore can reward the shareholders of today, which of course will include some of the key parties that are inside the organization as well.
So one of my next questions, so I think that's a good overview, right, of what a share buyback is and why companies do it. So when I read that headline in the Wall Street Journal, my first question was, okay, who's initiating these buybacks, right? Are there certain sectors, companies, industries? Because a lot of what you hear about in the news right now is the significant CapEx spending that these hyperscalers are doing in the realm of AI. You know, I heard just a mind-blowing stat the other day that the growth, like in nominal terms, in real terms, we have had more kind of growth in AI spend, enterprise spend this year than we have in consumer spending. So consumer spending is 70% of US GDP. And I think the difference between consumer spending this year and last year is something like $87 billion, right? And that's out of like a total pie of 16 trillion. So it's like nothing, right? And you've had $150 billion in incremental AI CapEx this same year. And so just to put in perspective kind of like how much capital investment some of these companies are making, it was surprising to me that at the same time we're seeing record share buybacks as well, because I know that they're deploying cash elsewhere as well. But a lot of that AI CapEx is really driven by 5 to 8 companies. And so I was really curious, are these the same companies that are also buying some of their shares back? Are there other companies? And so I actually, full disclosure, I didn't read the Wall Street Journal article. I saw the headline and I was like, we should talk about this. And so I want to dig into it now and just see, okay, do they have insight into where this is coming from? And so let me share my screen and let's see if we can figure this out. So here you see the subheadline here, buybacks are expected to top $1.1 trillion in 2025. Here we go. We've got our first clue, led by big banks and tech firms. And so I'm just going to scroll through here a little bit. Yeah, the biggest repurchasers include tech giants Apple and Google parent Alphabet. You've got big banks like JP Morgan Chase, Bank of America, Morgan Stanley also leading the charge. I'm a little bit surprised at the Alphabet news just because I know that they are one of the hyperscalers. And so the fact that
and Apple, honestly, like, I mean, I think Apple's making it's because of Apple's current core business. It doesn't make a ton of sense, but like news would have made sense a year ago. Right now, I don't know if it does.
I think one of the challenges that Apple is having right now is with its storytelling. Right? If you ask me, kind of the number one job description of any public company CEO is to tell the story of the company. And I think one of the things that Apple is struggling with right now is just what's our story? What's our narrative in the age of AI? So they don't really have a consumer-facing AI application that is noteworthy or relevant. That seems to be what investors in the market are really valuing right now. And so I think one of the reasons they are repurchasing stock is to kind of artificially keep the value high until they figure out what their story is. That's me reading between the lines. But they have over $200 billion in cash reserves. They are deploying some of it to kind of repurpose supply chains and nearshore and onshore and like all of the announcements we've read about over the last week. But they are in a really strong cash position. And if they feel like they don't necessarily have the know-how or the clarity yet on how to invest in an AI application, it makes sense to me that they would be kind of repurchasing shares at least a little bit. But it just tells you about all of these big tech companies, how much cash they have on hand that they can simultaneously invest in the CapEx while also repurchasing shares at this level.
Couldn't agree more. And I think that's a really interesting hypothesis, Namaan, that you think that they're basically what you're saying is that they're repurchasing for the wrong reasons, right? Like they're not repurchasing because of corporate strategy. They're repurposing for communication strategy.
Yes.
And if businesses are doing that, then they're just trying to message to the market. That's exactly what, and Apple's not really in a position for a hostile takeover, but that's exactly what leads companies into hostile takeover territory later, is that they try to stave it off for the wrong reasons instead of just like fixing their house, right? Instead of just getting business in order.
Well, and you can see in this data visualization right here, Apple has authorized $100 billion in stock buybacks this year. The next closest is Alphabet, and they're at 60. So like by, a large percentage, Apple is leading the way in terms of buying back stock. And I think it's for the reasons that we've mentioned. One of the other reasons I don't think it's mentioned enough is just this. I think this is one of the effects of the One Big Beautiful Bill. So one of the provisions inside of that bill that passed was 100% expensing of corporate investment. And so that's leading to, I would imagine, pretty large tax savings for these corporations. And what are they doing with those tax savings? They're repurchasing stock. I think that's another driver of this.
That's very interesting.
Yes. Mm-hmm. Yeah. So I'd be interested to look at the numbers, but I would imagine that that's one of the reasons why a lot of these companies are flush with cash right now.
I think the other thing that's really like interesting to note here is that there are sector trends that happen when you are valuing a company. You're not valuing it in isolation. And when you're trading a company, you're not trading it in isolation. You trade it versus its peers. And it's not just based on mechanics. It's not just based on how many customers they have and how much they spend. And it's based on a trade based on the expectations of their earnings. And those earnings here are going to be largely driven by a share buyback period. So what it doesn't show here, Namaan, is when the first announcement was or who the leader was in the financial services sector. But you see financial services after financial services, not all of them are going to be in the same position to buy back, but all of them are going to be pressured to buy back in the same season
just to keep
because
pace with their
they have to keep
competitive
pace.
set.
That's exactly right. And so it's again, like these are how market bubbles get created when you develop this kind of competitive pressure. And that's one of the reasons that people are critical of share buybacks, is because they do artificially increase it. But let's say like looking on here, right? Let's say Bank of America is in a weaker position than JP Morgan Chase to actually make a buyback. They weren't the first one to initiate it, but they have to flex to compete. That can put the business at risk in a downside turn. And then, different businesses are less durable to those kinds of turns, which is some of what happened in previous recessions, is that businesses got pretty big in their britches. And they do it for competitive reasons. Like they do it because they kind of have to, but it's not always the fundamental correct business decision for every org.
Yeah. And I would say for the organizations we're seeing here, it probably mostly is, a defensible decision, right? Like, I have my reasons for why I think Apple is doing this. I think that they're grounded in some kind of evidence base, but there's no arguing the fact that Apple is a strong and healthy business. They have
with
strong
a ton of cash.
With a ton of cash, right? So like they can and probably should, right? I think the opportunity cost is just the biggest argument here. Is like, what else could you be doing with that capital if you're a company like Apple, if you're a company like Bank of America? And so they are strong businesses. They all have healthy balance sheets. Their earnings are strong. It's just a matter of, is this the optimal decision for you to be taking with your cash, yes or no? That's what CFOs are paid the big bucks to figure out.
Absolutely. And again, I think that the news makes sense for Apple. I'm less confident that it makes sense now. So, I remember looking at Apple's earnings reports over the last 10 years from B school onward. And it was kind of like, yeah, they should probably do a share repurchase, right? What else are they going to invest in? We're trying to think of like, who do you acquire if you're Apple that makes sense? You have internal capabilities to do a lot of these things. You're not going to vertically integrate manufacturing. Okay. Like, right. You're kind of thinking through a lot of the different pieces of how they would operate. And there weren't a lot of choices. I do think Apple and Google are not fair comparisons here because, especially in the race for AI, I think Google's entire business model is completely at stake. And I do think that, but for the same reasons, like, Apple is fundamentally right now a product company, and we, in a world of AI, will still buy iPhones. Google, like, we may not, in 5 years, Google search could be gone, which means that their entire advertising platform would be totally gone. More likely that it's going to get remade, but you need sometimes cash to do that.
One of my big questions here, and I don't think the article answers it, and maybe it's just too much nuance with kind of the broad landscape view that this article is trying to provide, is just what's the runway for these share buybacks? Just because Apple announces $100 billion in share buybacks, it doesn't mean that they're buying $100 billion worth of stock tomorrow. Like, you usually kind of commence this kind of buying program over a 12 to 18 month period. And so I think that's kind of one key data point that's missing here beyond just like buybacks announced, is like, what's the velocity of those buybacks? And then the other kind of key data point that I would want to see, to your point, is just kind of what's the size of these companies? And so like as a percentage of cash on hand or as a percentage of earnings, who is kind of initiating the biggest buyback? Because you're right. It's just saying
the buyback
JP Morgan
is one thing, but what's left is really the more important piece.
Exactly, right? Like JP Morgan's buying back 50 billion, Bank of America's buying back 20 billion, doesn't necessarily, give you the whole picture there. And so that's, again, a secondary data point that I would go pursue on my own, is let me look at the earnings, let me look at the balance sheet, let me figure out this in percentage terms, and then also let me go see if I can figure out what the runway is, and that's going to give me a better picture if I'm an investor, right? For like which buyback program I'm more jazzed about than others. And it's also going to give me a better picture just as a business observer as to how these management teams really think about their own businesses and how strong they think they actually are.
Overall, this might have sounded a lot like a investing podcast where we are talking about, how share buybacks get valued, but that's not the point. I just want to bring it back to the big picture. The point is that if you understand that companies are buying back shares, it means something. And it might mean what some people say it means. The reason this made headlines in the Wall Street Journal is that the Wall Street Journal is generally, especially right now, pretty bullish on the economy. And they're looking for cracks in the economy, and this does not reflect them, right? Lower share buybacks or no share buybacks does reflect a crack in the economy because companies protect their cash on hand the same way that consumers do, right? We pull back from spending and we think about what we might need to do in order to make it through periods of high turbulence. But, what this is really saying is that especially many of the largest companies in America are not thinking like that. They're not risk averse. They are continuing to invest, and they're actually pulling cash off of the table through these share buyback programs. And that is, like Namaan mentioned earlier, a very strong sign for the U.S. economy, and especially these sectors, tech and banking in particular. I think that what remains to be seen, which we're just kind of calling out here, is whether these are true strategic, isolated incidents that just happen to come together because everyone is like, the economy is great and everything is going to be phenomenal, or whether these are, as we often point out, singular business decisions that then happen to become sector-wide because of competitive pressure. And if you don't understand how that could happen, then you could take one conclusion from it, which is everyone's doing great and the economy is awesome, which is what you could have concluded about airlines in 2018, 2019 when they did their big share buybacks. What was really happening is that coming ahead was a big bump in the road and they weren't ready for it. And so, really making sure that you kind of understand where those implications get tied together so that you're trusting but verifying data like this, and also understanding why it matters to a source like the Wall Street Journal, I think is very vital.
And I'll just say, Jenny Rae, to that point, as you were talking, I was thinking about, okay, what's another implication of this? I think it's a sign of the strength of the U.S. consumer. Think about the companies that are buying back stock. It's Apple, it's Alphabet, it's JP Morgan, it's the banks. They have more consumer data available to them than almost any other company on the planet, right? Collectively. So Apple knows a lot about us. Google knows a lot about us. JP Morgan knows a lot about its customers, Visa, MasterCard, etc. So if they are taking cash off the table, I think what they're really saying is, we believe the consumer is in a stronger position than maybe the headlines would make you believe. Because if the consumer's not in a strong position, that would directly affect their businesses. And they would be keeping cash on the table. So I view this as also like a window into what their data is saying about us and saying about the U.S. consumer, because our spending makes up 70% of U.S. GDP. And so what they're seeing in the data must be strong for them to take moves like this. And that to me is kind of one thing that's not readily apparent from looking at the headline, but as you just think about why you'd make this decision, you wouldn't make this decision, as a company or as a sector, if you didn't believe that the customers you were exposed to were in a strong position to continue to spend.
Absolutely. Well, we hope that you've enjoyed this episode of Market Outsiders. Please subscribe for future episodes. We're here at least a couple of times a week. We do travel and we do other things in business. But if you're interested in having us advise your business in this moment on key strategic issues, or like we talked about with Apple today, how to communicate what is happening or what you would like to communicate into your markets, we would love to help you. Please feel free to reach out at the link that's in the profile. And if you have any questions for us that you would like us to include on a future episode, other than subscribing and reaching out, please make sure that you just follow along so that you can see us in the future. Come back and join us. Have a great rest of your day. That's today's Market Outsiders. Real insights, real fast. Join us live each weekday at 9:15 a.m. Eastern on LinkedIn and YouTube. But make sure you're subscribed to catch all the action as it unfolds. If you have questions or a story you want us to cover, reach out anytime to team@managementconsulted.com. Plus, if you love Market Outsiders, share it with a friend or colleague. We'll catch you next time on Market Outsiders.